Hello, I'm Ami Marishi, Doctor of Business Administration candidate, and today is 10th of August 2026, and we want to talk about Iran, the Persian Gulf, and the Strait of Hormuz, why global markets remain exposed. The Strait of Hormuz remains the biggest immediate risk to global energy markets. First, let us understand the geography. The Strait of Hormuz is the narrow sea route connecting the Persian Gulf with the Gulf of Oman and the Arabian Sea. Before the current disruption, around one-fifth of the world's oil and liquefied natural gas, known as LNG, passed through this route. This is why a problem in one small waterway can affect businesses and consumers around the world. Iran says its proposed shipping arrangement with Oman is in its final stages. However, this arrangement mainly defines possible new shipping lanes. It does not mean that the strait is fully reopening. Iran says reopening also depends on several actions by the United States. The United States has presented a different order for how the process should happen. Therefore, there is still no confirmed operating framework accepted by all sides. Limited vessels are crossing, but normal, unrestricted commercial traffic has not returned. For business, this means uncertainty remains high. Now, let us look at the markets. At the time of recording, Brent crude oil was around $84 per barrel. US crude, known as WTI, was close to $79. Oil prices fell more than 7% last week when investors believed an agreement was close. On Monday, prices rose again when Iran made clear that a shipping arrangement would not automatically reopen the strait. This shows an important business principle. Markets price expectations before the physical situation changes. Gold was trading around 4,030 $330 per ounce. It was slightly lower on Monday after gaining more than 7% last week. The uncertainty around Iran and the Strait of Hormuz supports demands for safe assets. However, gold's recent increase was mainly driven by weak US employment data, lower bond yields, and reduced expectations of another interest rate increase. Bitcoin was close to $65,000. Bitcoin is not directly connected to oil supply. It is also not as reliable as gold during a crisis. It can rise when investors accept more risk, but it can fall with technology stocks when investors become nervous. Therefore, today's Bitcoin price should not be described as a direct reaction to Hormuz. Global stock markets are also showing a mixed message. At the latest US close, the S&P 500 reached a record 7,757 points, while the Nasdaq gained 1.3%. Asian markets were mostly higher on Monday. This does not mean the Hormuz risk has disappeared. Uh, Stocks are being supported by strong corporate earnings, artificial intelligence companies, and lower expectations of an immediate US interest rate raise. The stock market is balancing positive earning against higher energy and geopolitical risk. European natural gas is another important indicator. The European benchmark was around 56 to 57 euros per megawatt hour compared with approximately 31 euros before the conflict. The market has a stronger connection to Hormuz because disrupted Qatari LNG exports create more competition between European and Asian buyers. ADNOC Gas reported that its second quarter profit fell 52% compared with the same period last year from $1.39 billion to $665 million. Its sales decline aimed at the closure of the strait. This teaches us that a higher energy prices does not automatically create a higher profit. A company cannot benefit fully from higher prices if its product cannot reach customers. The winners are businesses that can still deliver energy into a high price market. Producers outside the Straits of Hormuz, including some American, Norwegian, and Australian oil and LNG companies, may benefit from higher demand and prices. The companies under pressure include Persian Gulf exporters whose oil or gas is delayed, airline paying more for jet fuel, import dependent economies, manufacturers and customers paying higher freight and insurance costs. Shipping is more complicated. Cargo owners pay much higher transport costs, but some tankers owners can earn higher charter rates. Insurers may collect higher premiums, but they also face greater claims and sanctions risks. For Iran, the most important equation is usable oil revenue equals the actual selling price multiplied by export volume and the ability to receive payment minus discounts, shipping, and insurance costs. A higher global oil price helps Iran only when Iranian oil can leave the region and Iran can receive the money. There are now three possible business scenarios. First, full reopening oil and gas risk premium could fall, exports volume could increase, while airlines, manufacturers, and consumers could benefit from lower fuel, freight, and insurance costs. Second, a limited shipping corridor. Some energy could move, but uncertainly, sanctions, inspections, and insurance restrictions would continue. Prices would remain volatile. Third, no final agreement or another major disruption. Oil and European gas could rise quickly. Gold could receive additional support while airlines, transport companies, and risk sensitive investments could face pressure. The key indicators to watch are not only political announcements. Watch actual tanker traffic, export volumes, insurance coverage, payment rules, and the final written agreement. The market is pricing the possibility of reopening. It is not yet pricing a confirmed return to normal business. This is Amir Marishi with Elite Talks. Have a good and lovely day. Thank you.